Okay, so we're live. So hello again, guys. My name is Marek Niedźwiedź. Oh, hi, Rick. Good to meet you again. So let me share my screen then. We are going to talk about the oh, my dog's shouting. Evergreen funding. Hope you like this. Can you see my screen?
Yep.
Okay. Right. Let me just start this view. Okay. I'm ready. So some time ago, I was raising capital for healthcare bolt-on acquisitions, and I approached a private equity fund, was looking to secure 20 million pounds. That was UK-based project. And the fund manager listened, and they said, we like the project, we like you, we like the materials you presented. However, come back to us when you are asking for 50 million. And I was caught off guard for a moment. And I then asked, okay, so what are your return or timeline requirements for this capital? And they said, don't worry about it. That was the sentence, don't worry about it. And we are Evergreen. We've got Evergreen funding, which I didn't know what's that. And this moment changed the way I thought about capital. And this is what I'm going to talk about today. Again, in this healthcare roll-up, I worked on, we secured Evergreen funding through a private equity firm, which committed 50 million in perpetual capital. This is called perpetual capital. And this allowed us to focus on sourcing and integrating accretive acquisitions rather than worrying about the next funding round. So we were supposed to deploy the whole 50 million within the next 2 years. Some of the funds, obviously the Evergreen funds, they actually, they open all, so you can actually acquire companies over the period of 5, 7, 10 years, and you've got access to their capital. Okay, so what's Evergreen funding? It's a sophisticated concept commonly used in Wall Street cycles. While it is not a new concept really, but its appeal has surged recently as investors and businesses look for scalable long-term capital solutions. And this structure aligns perfectly with what we want to do really. High growth strategies, ideally for M&A, like roll-ups or post-acquisition scaling. So, and I kind of realized that, I was doing small acquisitions before, but I realized that, you have to go big or die. Again, in the healthcare roll-up, we initially planned smaller acquisitions, but feedback from the investors, because at the same time we actually raised more capital, 27 million from that was debt funding, and so actually the feedback from investors was they pushed us to think bigger. As I said, I was looking for 20 million. Finally, we landed with 87 million. And again, we not only attract Evergreen funding, but also gained the investor confidence needed to scale rapidly. So Evergreen funding isn't about small incremental deals. It's about building a compelling, scalable vision. And if you want to grow through acquisitions, aim for size, quality, and alignment with investor, obviously, expectations. The bigger, the easier. The bigger, the easier in terms of capital. If you want to know how to do it, how to scale your vision, how to build a team, how to build a deal flow, that's obviously was the Harbor Club does for us. But also you can reach out to me because I've gained some experience during the course too. And so in terms of what's the evergreen funding sources are actually. So usually private equity firms, but not only. There are family offices, there are some venture capital, the larger venture capital firms, some institutional investors as well, but that's probably not our target. And even public markets. So again, companies can raise funds through the issuance of shares or bonds in public markets without traditional IPO timelines. And you can regularly raise additional capital to fund growth while maintaining operational independence. So I actually was talking about that probably on the last episode. And practical tips for everyone. So if you are looking for for this kind of funding, which I strongly recommend, again, because you've got like a credit line, whether that's equity or debt, that's your credit line. So the bigger your vision, the bigger the credit line for you. But you definitely have to show the two main things when I always repeat is your deal flow, and your team. You have to have the strong team. So for example, you can bring like a non-exec chairman, you can bring non-exec industry experts, maybe 2 or 3 people. You don't pay them, you pay them probably through stocks, but you have to have these people around. And obviously, again, the strong deal flow, which again, kind of within some particular industry, that's the story you have to have on hand when you approach this evergreen funding. Again, at the same time, obviously showcasing synergies between those businesses. As I said, we at the same time we raised debt capital as well. So diversify this capital, some equity and maybe some debt as well. Once you've got equity committed, that's much easier to raise more funds in terms of debt. And yeah, probably some kind of size of the businesses in your deal flow, again with strong revenue, historical revenue, and some size. Probably we're looking for businesses at least $500,000, but ideally 1 million plus EBITDA businesses within your pipeline. If you've got this, that's absolutely appealing story. There is so much capital now, as I mentioned before. The dry powder, which is the capital looking for projects, capital looking to be deployed now, is about $4 trillion globally. Half of it is probably the US and the UK, if not more. So that's from me. And again, yeah, I've got a question to you. So guys, maybe what's your biggest challenge? Because people usually say, obviously, we cannot raise money. Whereas I see there is so much money out there, and probably the problem is more on deal flow side and team side. But again, I'm very interested. What's obviously you're looking to for acquisitions, I guess. Maybe not particularly maybe this roll-ups straight away, but you're looking for acquisitions. What's your biggest challenge? If you can share with me, guys. Anybody want to share?
Yeah, I reckon I was gonna say the lead flow is always a bit tricky to keep the tap running, right? To be continuous with the leads. So I think it's good if you already got like a track record in terms of buying businesses or managing kind of few large businesses. It does help a great deal. But when you're still kind of putting your group together or your first acquisition, the lead flow, it definitely is a challenge to maintain the consistent to make sure that you're getting leads that actually make sense later on.
You mean the
So
targets, the companies you potentially want to buy?
yeah, the company.
Okay, yeah. Okay, yeah. Thanks, Ali. Yeah, I mean, probably again, maybe you can start with building a team. You're just selling your vision, and once you've got the team, that will be easier to build your deal flow, to speak with these companies, with more credibility and confidence. Again, that's my kind of opinion. But having the team be behind you, that's really, really powerful, not just for the capital conversations, but also for your deal flow. So maybe you can start from this, building like again, advisory board, non-executives, whatever, 4, 5, 6 people ideally, who will buy your vision into.
Yeah, I think JV will helps a great deal.
Mm-hmm. Rick, do you have any? You've come across with this Evergreen fund?
No, I never.
Before?
I was interested to learn. I'm going to have to read about it now and find out how it works. I don't really have a problem with deal flow. The nature of the nature of what I've been doing for 20 years means that I have another business that is a partner to my merger and acquisition business, but it's the business I've been running, and I started it in 20 years ago next year. Effectively, we're an Oracle partner, and we put ERP systems in businesses. And the businesses go from 5 to 500 million, and we have clients in that range somewhere. They tend to stay with us because we're a safe pair of hands. And that's taught me how to fix businesses. The clients usually come to us through private equity. So along the way, I know I know a few private equity guys at international board level. So I went to them and I said, how do you find the companies you want to buy? And why don't you buy the smaller ones? Now I know why. Now I'm learning why. Partly for the fact it's really difficult to fix small ones because they've got no resource and no knowledge and no experience. And the bigger ones can afford the experience inside the team. So that's kind of the main differentiator I found. I bought an engineering company 18 months ago that I now no longer have. And that was turning over 1.5 million. And it was riddled with complications because of its lack of size. The jobs it needed to do were half its turnover, and it couldn't get the jobs because it wasn't big enough. It was a constant struggle. So this year now, I've looked. I'm looking for businesses of 5 million plus in the engineering sector, and I think that the way the UK is going, doing a roll up in that sector is going to be a great idea. I'm kind of fairly I'm sector agnostic in as much that I won't touch retail and I don't like hospitality, so I don't really understand them.
Yeah.
So if you've got a gym, if you've got a hotel, I don't know. I've got friends who know how to do that, but I don't. But if you're a B2B business, I get it. I understand it. Mm-hmm. So what I've found a challenge is funding. I use my own money. And at the point of which you get to 5, 10, 15 million, I don't have that much. So I need to use other tools. Everybody says never use your own. So I'm here to learn. And when I hear that there's evergreen funding that's constantly available, it sounds like somebody's invented a magic money tree. Mm-hmm. So I need to go and find out what the soil's made from and how do I get a piece, or who can I, aside with to. I don't have a problem with deal flow. I don't have a problem with getting a board together. We do JVs all the time, and we tend to find out things because of the nature of what the other business does. We're just always doing stuff like this, so I just tend to be around deals all the time.
Yeah, if you have deal flow, again, deal flow is, in my opinion, when this is not just my opinion, but what. Again, this is what the capital wants to see, your deal flow. As you probably spoke to these guys, the private equity guys, and I'm 100% sure that they said the deal flow is the most challenging part of this job, really, to find proper companies, platforms we can invest to. So again, if you have strong deal flow, again, with companies with some specific size, industry, the narrowed industry, the better. And if you can build a team, so approaching this kind of funds, I'm not saying just evergreen funding, but the founders, whether that's debt or equity or even or maybe mix of it, is probably much easier that what most of the guys within this network do. They go to and then they raise money through the invoice finance. They raise money through some loans, and they obviously give the personal guarantee, etc., because they buy just one business. Whereas if you have the deal flow and you can create this group of companies, so this is much easier to raise money for that kind of platform of groups, of companies, rather than buying a one company by and then just getting this very expensive and risky debt. Yeah, guys, and anybody else, do you have any experience in in funding and evergreen funding at all? Probably not. Okay. Yeah, and any questions? And do you have any questions, Sergio?
Well, I mean, like Rick elegantly put, so many in the pond I fish in, and I'm just getting started here looking for the bigger companies. But in my clientele as a business consultant and a turnaround person, the smaller companies, to me, I feel like 99.9% of them are dogs. They're just dogs with different fleas, and I have opportunities that come by for smaller companies, especially say like HVAC or any of those service industries, but they're already leveraged tremendously, or they've pissed away their funding in making bad decisions. So for me, I think the number one issue is just deal flow at this point, just finding the right size deals, finding the right companies. I've worked with some companies up to about $5 million, and even they, one company I consulted with, I took from 2 million to 10 million, but they even had, I mean, to me, the problem is these companies, they still act like small businesses instead of, okay, the company's
Yes.
making $5 million and they're still running it like it's a $300,000 business.
Yeah,
So,
that's another challenge, really, because
yeah.
the deal flow again. What the good or strong deal flow really means is, when you present this to your investors, then obviously this is why these small companies, they not a strong deal flow, really, because there are no, you don't have these processes, systems in place, as you mentioned. They usually still within this kind of owner based or owner mind business,
Sure.
kind of. So that's very challenging to bring some capital. So again, the size of your deal flow is really important.
Yeah, and
And that's
another
challenging.
aspect,
Yeah.
is that when you're dealing even with some of these companies that are $5 million, they're still struggling with lead generation. They're still struggling and trying to get some sort of market share. To if you're going to a funder, they want to know. My experience is they want to know, well, how much of the market do you really have, and is it a local market, is it regional market, and and when you're dealing with the small businesses, they're almost completely localized to a certain extent, and they're very limited in their reach from a marketing standpoint.
Yeah.
So trying to find some of these bigger businesses, and I'm quite honestly, I'm struggling with trying to figure out where to find these companies.
Yeah. So you're based in Florida.
And
So how do you find, you've been, as I said, you've been working with this in this space for the 10 years plus. How do you find this, today versus what was 5, 10 years ago in terms of small business, whether they, they struggle, they on better shapes, or how would you say that, describe this
well,
today?
I mean, many people ask me like what my niche is. I come from an IT background, but I mean, to me, and I said this in the beginning of the call before everybody got on, I said, they all seem to have the same issues, regardless of sector. They either don't have proper lead generation, they don't have their processes, in place, and they're lacking a certain amount of financial understanding. when I get, and I give workshops a lot, and when I get people in there and I ask them, okay, so what's your best selling service or product? And they'll tell me, and I'll be like, okay, so what are your margins on that? What are you making on that? And a lot of them can't even answer that.
Mm-hmm. Yeah.
You say, oh, well, that's our best. And all they know is that they're looking at their cash flow statements and like, okay, we sold a lot of those, but you can't give me percentages, you can't give me a margin. We've got some problems there. And I think this is way, way, way premature to starting to look at, companies that would need significant funding to scale. I mean, if they haven't gotten some of these basic things out of the way yet, then this is a very, very premature conversation. But even some of the companies I work with at $5 million because they got in at a proper time in a proper place, and the money's coming in, and they're pissing away a lot of it. They're buying boats, they're buying houses, and they're not really reinvesting in their business. And sometimes they get to me and they're like, yeah, our cash turnover is $1 million, or let's say $500,000 a month, but somehow at the end of the day, we're short tens of thousands of dollars. And now, I have to go in and show them, okay, this is why, you're funding your losses, but here's why.
Yeah.
It's kind of crazy.
Yeah.
I see
That's
Rick over there laughing.
Yeah, that's my experience too. It is usually the small businesses, the first thing so what you have to do is just bring the financials up to the standard, and just what's measured improves. That's very,
Correct.
very simple. And that's the first step, very big step.
Well, and for so many of these companies, their measurement is, well, there's still money left in the account at the end of the month. That's not a measurement to me.
Yeah. Anyway, so yeah, I'm asking about Florida because obviously the US as well, because some of the the global economy, some of the KPIs, I would say they look really, really bad. But again, that's kind of macro, a global level. I'm not sure how the small business, whether this already affected small businesses, or they will, or that's maybe my interpretation, maybe bad interpretation. I'm not sure.
Well, I don't think you're too far off.
It doesn't look good, to be honest.
Yeah, I don't think you're too far off. Now, Florida, compared to other states in the United States, is considered a better state to be in. We don't have a state tax and that kind of thing. But when you're, especially if you're B2C and your customers are not coming in because there's a recession, or our inflation over here is a bit out of control. It tends to hurt a small business way more than it does somebody in the M&A market.
Yeah, that's why I say consolidate or die. That's probably small business will struggle. The currency devaluation, huge currency devaluation. That's another factor. Okay, guys, do you have any questions about the Evergreen funding, or maybe about the capital generally?
Yeah, I was gonna ask, Merrick, is there let's say if you want to acquire a particular business, or maybe you're looking for funding, would you say, is there like a funding deck that you need to put together to get the Evergreen funding?
You mean the pitch deck, like a presentation?
Yeah.
Oh,
like
yeah, absolutely.
Particular
Yeah.
format. I mean, that'd be great to see, because if I know that's available there now, I wouldn't do a bit more homework, like Rick was saying. Then for the acquisition I'm looking into, if I can put a deck together towards that, that'd be great helpful, because then it gives me more option for access to funding, right? But if I can put it together and know what the particular PE firms look for within the deck and what makes sense to them, then it creates a better kind of framework for me to work with as well. So
yeah, Ali, but you have to realize that I'm talking about the kind of, again, funds that they will sign a check if you ask them, again, 50 million. 20 probably is still too small, so we're probably talking about not just one acquisition, or maybe you've got some kind of good companies but maybe a group of companies, then 50. And the Evergreen funding is kind of, like I said, open credit, so you can 50 million, for example, you will deploy this in 2 to 3 years. You will be buying companies, but you have to have the deal flow already to show them. And so, yeah, as I said, the deal flow with the team is the most critical part of this story. And obviously the pitch deck, again, you're talking to institutional investors, so the pitch deck is, this looks slightly different. You don't need to, like the startups, they usually play around the emotions, the kind of story, blah blah blah. This is more in financial language, I would say, like investment bank like pitch deck. So that's there are more text, more data, more graphs, more KPIs, rather than kind of whatever, story and some photos, pictures, etc. So the pitch deck is obviously very important. Some 9 to 12 maybe slides, but that will include your deal flow, kind of summary of your deal flow of your team as well, and some what you're looking for in terms of 3 to 5 years, what's your exit strategy, if any, and also ideally if you already have financial model. So financial model, basically this will be done in Excel, showing your deal flow, for example, company A, B, C, D, and their financial statements, and obviously the pro forma kind of financial statements with combining all these acquisitions, and obviously including some synergies achieved. So yeah, financial model, pitch deck, and obviously your team. That's the things. And deal flow, again, the 4 things you have to have. Yeah.
Yeah, thanks for that.
Yeah, but again, the pitch deck is it's slightly different than we usually been probably doing in the past. Like we know in small business or startups, this is more for financial, for very analytical people. They're looking for specific KPIs, they're looking for specific information. Yeah. Again, if you need any help, let me know. If you have, but again, I would start from building the team and the deal flow. Once you've got it, you can build around, we can build a pitch deck and ideally financial model for that to support this presentation. And the capital today is not the problem. If you got this right, capital is not the problem today. Guys, there are a few people joined, so yeah, if you have any questions, we spoke about Evergreen funding. I'm not sure if anybody who just joined has come, across with this kind of funding. Hi, Ronald. Emre, hi.
Yeah, hello, Marek. Hope you're all right there. So just as a question, obviously, not too 100% clued up with LBOs and everything. I'm still all just learning. Obviously, when you're operating at that level of 50 million plus and all that kind of stuff, does that still? I don't know, with what you've talked to these guys, does that still operate the same as, like, let's say an SBA loan where you have to put 5% down or 10%? Or that kind of stuff, like some kind of equity down in the deal? How do you know how does it exactly operate, just for planning in the future or whatever?
Oh yeah, that's a good question. So obviously, my experience is mostly around. I would split this into 3 areas. One is when you, for example, you already have some, they call this platform, which is basically your company. So you, for example, you acquired a company, or you've been running this company for some time, and this is like I don't know, maybe 5, 10, 20 million, whatever revenue company, and you want to acquire companies within your space, and yeah, that's called kind of bolt-on acquisition platform. And so no, you don't need any really any kind of money to put into alongside with these guys. Another approach is when I'm actually now working with the guys on such a platform now, where you don't have any company yet, but you create like a holding company with the aim to acquire other companies in, for example, sector or industry A or sector B. So that's and again, if you have a very strong deal flow, I believe these are the companies are kind of asset backed companies. They, again, the approach is one up, you can approach this private equity or whatever, the funders, and they will invest or they will lend the money to you without any you don't put any you're not putting any cash from your end. And the third area is when they would require, maybe you have like 5-10%. If you don't have any company yet, then yes, but definitely there is a funding available when you don't need to put any cash up front, having given the fact that you as I said, you've got a very strong deal flow, which means good companies, established companies, ideally asset-backed companies, at certain size, obviously, and you've got a strong team, non-executive or advisory board behind you, again 5, 6, 7 people, and you've got and material, as I said, financial models and pitch decks. Then there is even if we're talking about lending, the debt funding, this is not you don't there's no collateral. I mean, there will be some collateral on the company's assets, but not your assets, not your PG whatsoever. So yeah, that's kind of approach. Definitely there is a funding for the larger deals is easier because you don't need to put any money into the deal. You're bringing deal flow, you're bringing team, and you're bringing your operational involvement for the next 3 to 5, 6, whatever years. Yeah, but some of them, yes, they will ask, what you put into, what's your skin in the game.
Right. Okay. Yeah, and I'm guessing some of these guys are gonna want part of the deal. Let's say they want to hold 20% or whatever. If you get what I'm trying to ask on that.
Yeah, that's a bit depends on your business model, whatever, if you have a deal flow of, again, what's your valuation strategy, what's your acquisition strategy, whether you acquire 100%, you acquire majority shareholder shares, that will influence, how much equity you have to give up for these guys. But again, ideally, you can raise some equity. You have some equity funders plus some debt funding. As I said, the case I was talking about was we raised 50 million in equity plus 27 million in debt without any personal whatever, this personal guarantee or without any money putting into the deal. Obviously, again, that was a platform, or that was the company already operating for some time, so that was probably easier, but still doable if you start from scratch. But again, your team will be very important.
Yeah, no, that's right. Thanks.
Okay, guys, any more questions? Yeah. So listen. So yeah, if you have any, reach out to me through app or or maybe through my websites, and good luck, and good luck. Again, the bigger the better, and the cash is there. The cash is there. What we need is to build proper platforms to present to the capital, because there is more capital now available than projects. And again, if you want to deep dive into it, reach out to me. We can discuss this further, because I speak to capital on quite regular basis, and I'm actually looking for some projects in Europe for the US investors, because they the valuation arbitrage is quite, it's probably 40% difference between the same company valued in Europe versus in America. So that's why it may be very interesting market.
Why is that, Marek? Why is that?
That's obviously we can talk about that a lot, but I would say only one thing: strong central bank. The access to capital, the other resources, because I personally think everything in business, what is influenced by the central banks, by the monetary policy. And in America, you've got very strong, the strongest central bank in the world, and you've created this economy that is really, it's strong, it's resilient, but at the same time it's very competitive in terms of valuations. So the valuations are much higher, and the 40% is not. It doesn't come from me actually. 1 week ago, I was in Toronto Stock Exchange having meetings with some, and it was a small conference, and having meetings with particular actually U.S. investors, and this is what they said. Europe versus America, 40% arbitrage, the difference in evaluations. That's a huge one, listen. So, let's but again, you have to have the certain size of your project, and a very, very strong, appealing team that will speak to, can be translated to this, because again, the risk is obviously high for the US capital coming to Europe, but especially in the UK, we see a lot of American capital, a lot, not just in healthcare, which is the hottest, but in technology, etc. But also in sports, like soccer, football, etc., etc. There's so much capital from America already in Europe, and especially in the UK. For example, I'm just working with guys on the mechanical engineering and this HVAC roll up, and there is another actually platform doing this, and they have, I think, 60 or 70 million evergreen funding from the US private equity firm. So yeah, that's this is what happens. This is what we've got already. So
very interesting.
Okay. Yeah, guys, thank you very much for today. Again, reach out to me if you have any questions. And I will see you next time in 2 weeks' time. Thanks a lot. Thanks. Bye-bye.